Now we discuss price gaps, how price gaps are formed, and how traders capitalize on these moves in the foreign exchange markets. Since we will witness this type of price action quite frequently when we look at charts, especially when the market reacts to some important economic indicator, some breakout from a long sideways movement, or maybe a reaction to some political news. There are 4 types of price gaps. The first is the common gap. This is formed when the market is illiquid, and this gap is not very significant as these gaps tend to get filled quite easily. And since the markets are illiquid, volumes are low, the significance of this gap is virtually zero. The second gap is the breakaway gap, which occurs when there is a breakout in either direction of a long phase of price consolidation. The breakaway gap occurs on heavy volumes and signals the start of a new trend. A large number of orders are usually placed on either side of a consolidation. Now we can take an example of how a breakaway gap occurs in the foreign exchange markets. There could be a large number of orders that are placed on either side of a consolidation, so that if a breakout occurs, these orders would be fulfilled and the traders would have a position either long or short in the market. Now consider the case of dollar yen, which has been consolidating for a while and it's difficult to judge the direction of the breakout. A trader, however, could capitalize on this by taking a position on dollar yen in whichever direction it breaks out by placing a stop loss order. For example, if a trader wishes to capitalize on the breakout in dollar yen, he could place a buy stop loss order at say 111.50 or a sell stop loss order at 110.80. Now the stop loss order would only trigger if the yen breaks out in either direction. So if the dollar yen breaks out on the upside, the stop loss order would get triggered, and so would hundreds of other orders. And since the volumes are large, the prices that the traders quote would be in gaps. So a trader might quote 111.20, 22, and he might get taken on 22 for a large amount. And when the trader goes to cover in the market, he might see a price of 30, 32 instead of 20, 22. And the next price he would quote to somebody else, since he knows that the market is running, the market maker would quote maybe 36, 37 or even 40, 42, and hence the price gap. The third gap is called the runaway or measuring gap, is when the prices are already jumping higher and somewhere around midway from the start point to the target, the prices start to gap. To see how this could happen, take the case of traders who have large unfulfilled positions or traders waiting to initiate their positions as they might have missed the move. Now these traders are waiting on the sideline, praying for a retracement of some sort, even 33% retracement. However, despite waiting for a while, they see prices moving only north and they start getting nervous. Those traders who've been waiting and can't wait any longer start buying at whatever price they can get to fulfill these corporate orders or stop loss orders, or traders who wish to initiate long positions. Market makers see this buying frenzy and start trending their prices higher again. If the market maker quotes 112.20, 23 and gets taken at 23, the next price he might quote is 27.29, depending on the number of calls he's getting and how many takers are taking his ask side. The final gap is the exhaustion gap. That's when most of the orders have been filled and the market is still pushing higher. The prices start waning. So this is where, when we saw the Dow theory, this is where the distributors look to start selling. They see a strong resistance point approaching, see momentum indicators as unsustainable, and may see a final price gap called the exhaustion gap, which fills up when prices start falling. So this exhaustion gap starts filling up when the prices start falling, and filling of the gap signals a move all the way down to the initial breakout point. So these are the 4 gaps and a bit of market psychology behind these gaps. Next, we take a look at trend reversals and how to capitalize on those.